Liquidity evaporated. $4 trillion of cash disappeared from the banking system overnight. That's exactly what the Fed's chief economist saw flash on his monitor when the first domino toppled in 2008. His blunt remarks sliced through the panic. Liquidity is gone. I'm Gregory Hale. I've spent 15 years tearing apart financial crises, something the headlines completely overlooked. In this video, I'll show you how a hidden liquidity squeeze in 2007 snowballed into a full-blown meltdown. A meltdown that almost toppled the entire global economy. Now, the System Dark crew isn't out here to scare anyone. We're here to pull signal out of the noise. Because the warning signs were flashing red lights on 1,000 screens long before the collapse. And those same forces are still at play today. Disclaimer: this isn't financial advice. Past performance doesn't guarantee future results. Source: the crisis began with a run on the interbank money market, leading to a freeze in credit that rapidly spread to depository institutions. Federal Reserve, 2009. What you're about to watch isn't merely history. It's a playbook, a real-time autopsy of how broken trust can shatter liquidity in just a few hours. Think of liquidity as finance's oxygen. When banks stop lending to one another, the whole system suffocates. And in 2007, that's precisely what went down. The first cracks showed up in the shadows of subprime mortgages, loans billed as safe, then repackaged into securities that were. Then the whispers started. Hedge funds began pulling cash. Money market funds hesitated. The interbank lending market, the lifeblood of Wall Street, started to clog. By early 2008, the squeeze was unmistakable. Banks couldn't borrow. Corporations couldn't roll over debt. The Fed's economist watched the numbers flip from green to red in real time. Source: a wave of bank runs in early 2008 forced regulators to intervene with unprecedented emergency liquidity facilities. New York Times, 2008. But here's the chilling part. The crisis wasn't only about bad loans. It was about liquidity, or more precisely, its absence. When confidence cracked, cash didn't just slow, it dried up. It vanished. And once liquidity disappears, getting it back is practically impossible. This isn't the first time. History shows the same pattern in the 1930s when bank runs shattered the monetary system. But in 2008, the stakes went global. The dominoes weren't only falling in New York. They were falling in London, in Frankfurt, in Tokyo. Source: bank runs in the early 1930s precipitated a collapse of the monetary system, providing a historical parallel to modern crises. Journal of Economic Perspectives, 1993. So how did it happen? How did a hidden liquidity squeeze spiral into a systemic panic? The answer isn't in the headlines, it's in the shadows, where banks, regulators, and markets played a high-stakes game of chicken with the financial system. And here's the question that keeps economists up at night. Could it happen again? Not in some distant future, not in a parallel universe, but right now with the same forces still at work. Source: lawmakers examine the need for a new financial regulatory framework after the 2008 banking panic. Congressional Report, 2010. That's what we're going to uncover. Because getting a grip on 2008 isn't just about looking back. It's about seeing what's coming next. The dominoes are already lined up. The question is, when will they fall? Early 2008's credit crunch didn't kick off with one wayward loan. It erupted as panic in the interbank money market when banks abruptly stopped lending to each other. Source: Federal Reserve Report, 2009. In just a few weeks, that hesitation hardened into a full-scale freeze, spreading through depository institutions and robbing them of the short-term cash they needed for daily obligations. When Bear Stearns fell in March, it served as the first headline-making sign that market anxiety wasn't limited to shadowy hedge funds. Overnight funding lines vanished for the investment bank, pushing it into a rushed sale to J.P. Morgan Chase at a fire sale price. Its collapse showed how one firm's failure to roll over short-term repos can set off a chain reaction throughout the whole financial system. Behind the curtain, Fed economists were already keeping an eye on the mounting strain. Internal memos from the Fed's Division of Banking revealed that senior economists had flagged a systemic liquidity shortfall back in February, urging the board to ready emergency facilities. Source: Federal Reserve Report 2009. The debate was far from unanimous. Some officials said market discipline should be left to run its course, worrying about moral hazard. Others, like then Vice Chair Tim Geithner, pushed for swift, unconditional lending to choke the contagion. On March 14, the Fed unveiled the Primary Dealer Credit Facility, PDCF, a backstop letting primary dealers borrow straight from the central bank against a broad array of collateral. The facility was unmatched in scope and speed, mirroring the urgency regulators felt after the Bear Stearns episode. Within days, the PDCF's balance sheet ballooned to billions, a stark indicator that the run on the interbank market had turned into a wider cash scramble. Source: Federal Reserve Report 2009. Still, the emergency loans didn't instantly fix the underlying dysfunction. The interbank market stayed frozen as banks continued to doubt each other's solvency. In the repo market, a key short-term funding arena, participants started demanding higher haircuts on collateral, effectively pushing borrowing costs up across the board. You could see the strain on the overnight index swap (OIS) curve, where spreads widened to historic levels, hinting that even the safest securities were being priced as risky. At the same time, the shadow banking sector, money market funds, structured investment vehicles, and securitization conduits began to feel the heat. These entities leaned on the same repo channels banks used, yet they lacked direct access to the Fed's discount window. When the repo market tightened, shadow banks hit a liquidity squeeze that forced many to sell assets at fire sale prices, pushing market valuations down further. The Fed's response grew more complex. By early April, the Fed rolled out the Term Auction Facility, TAF, an auction-based program offering term loans to banks without requiring a specific collateral pledge. The TAF was meant to sidestep the stigma of the discount window and pump liquidity deeper into the banking system. Inside, the debate moved from should we lend to how much should we lend, a question that hinged on real-time data from the Fed's flow of funds and the Office of Financial Research. Policy choices were steered by a stark historical parallel. Scholars pointed out that the 1930s bank runs toppled the monetary system, a lesson that rang true for the 2008 crisis. Source: Journal of Economic History, 1993. Fed architects realized that hesitating could replay the deflationary spiral of the Great Depression. So, the emergency facilities were calibrated to supply ample liquidity while resisting the urge to prop up insolvent institutions. The domino effect unfolded fast. As the Fed pumped liquidity via the PDCF and TAF, the interbank market started to thaw. Yet the repo market's strain lingered since shadow banks still couldn't tap central bank funding. To close that gap, the Treasury, under TARP, cleared $700 billion to buy distressed assets and backstop the capital of key banks. Source: Treasury TARP Report. That capital infusion helped restore confidence, yet it also underscored how public policy and private markets depend on each other. Lawmakers, meanwhile, held hearings to see if the current regulatory framework could survive another panic wave. The House Committee on Financial Services issued a report urging a new financial regulatory architecture to tackle the systemic risks laid bare by the 2008 panic. Source: Congressional Report, 2009. Those recommendations later shaped the Dodd-Frank Act, cementing the idea that the crisis was more than a string of isolated failures. It was a structural breakdown of the financial system. By late summer, the Fed's emergency facilities started winding down. The PDCF's balance sheet shrank as banks repaid loans, and the TAF auctions tapered off. Yet the credit crunch's legacy lived on as tighter lending standards, higher capital buffers, and a more vigilant supervisory regime. The first run on the interbank market, once a silent, technical glitch, had blown up into a full-scale crisis that forced the central bank, Treasury, and Congress to act together. Looking back, the cascade from the interbank freeze to the shadow bank strain shows just how intertwined the modern financial system really is. A single liquidity shortfall can echo across multiple markets, pushing policymakers to juggle the immediate need for cash with the long-term goal of preserving market discipline. The 2008 episode, documented in the Fed's own after-action report, still serves as a blueprint for how rapid, data-driven moves can stop a domino collapse before it topples the whole financial edifice. Source: Federal Reserve Report, 2009. When the Fed's top bean counter leaned over and muttered, "Money's vanished," you could hear a pin drop in that Treasury room. The words hit like a freight train, and suddenly those lawmakers were staring down a nightmare their fancy 2010 fix had never prepared them for. In a mad dash of policymaking, they tore up the old Dodd-Frank playbook and scribbled in a brand new line, keeping enough cash on hand to survive a cash-free doomsday. Source: The fix came in the form of cash cushions, piles of greenbacks banks have to stash above their day-to-day needs. And I do mean have to. It's not polite advice. These cushions are sized to handle a run the size of the Great Depression-era interbank meltdown. The Fed's own 2009 deep dive spelled it out. The whole mess kicked off when firms stopped lending to each other, freezing credit like a winter river. Source: To make sure banks actually keep those cushions fat and happy, regulators cooked up quarterly stress tests. Every giant bank gets dropped into a digital apocalypse, depositors yanking money, stock prices cratering, loans going bad, and has to prove it can ride out the storm without taxpayer lifelines. The results pop up online faster than you can refresh Bloomberg, turning what used to be hush-hush risk into a public scorecard. But plain old cushions and tests weren't enough to calm the ghosts of 2008. So the Brain Trust cooked up the FSOC, a bunch of agency chiefs whose day job is spotting too-big-to-fail behemoths and making sure everyone's singing from the same hymn sheet. The congressional write-up put it plain as day. After the 2008 meltdown, Congress said we needed a better playbook. Source: FSOC doesn't just point fingers. It can demand exit strategies, blueprints for winding a firm down without triggering the next panic. The Fed, Treasury, and SEC all kick the tires on these plans, making sure no single desk can miss the next landmine. Those emergency cash hoses the New York Times once called the only thing keeping the markets from seizing up became the rulebook for today's discount window and term repo spigots. Now the Fed can flip the switch the instant the red lights flash, dousing a crisis before it turns into front-page carnage. Source: Even the $700 billion TARP bailout fund, authorized to pour $700 billion into the banks so trust would trickle back, proved that one-off rescues can't stand in for a real, locked-down safety net. Source: Historians like to trace today's panic alarm straight back to the 1930s, when a simple bank run blew up the whole monetary system, showing us that liquidity drains always follow the same script. Source: Fast forward to now. Every big trade you make rides on cushions stuffed in balance sheets, stress test scores blinking on regulators' screens, and FSOC's radar sweeping the markets 24/7. When a mid-sized bank sees its deposits vanish overnight, the Fed can unleash a term repo in minutes. The cash cushion cushions the blow, and the stress test grade confirms the bank's still standing, no bailout headline required. So that economist's hushed warning didn't just patch a leak. It built a new dam. The dominoes that fell in 8 are now replaced by a row of rules whose job is to stop the next push before it even starts. Liquidity isn't merely digits flashing on a monitor. It's about trust. Then, in 2008, that trust disappeared in a flash. The Federal Reserve's post-crisis study lays it out. A quiet sprint across the interbank market froze credit, strangling the system right at its heart. Source: Federal Reserve, 2009. Fast forward to today, and those identical risks are lurking right under our noses. Shadow banks, repo trades, even money market funds cling to a shaky belief. That cash will show up whenever you reach for it. Beat TextPop, the Treasury's TARP logs reveal just how near we teetered on systemic ruin. $700 billion poured in as a frantic effort to revive confidence. Source: U.S. Treasury, TARP Annual Reports. History may not repeat verbatim, but it sure rhymes. Back in the 1930s, bank runs ripped through whole economies. What does that teach us? Liquidity isn't a given, it's a decision made by policy. Source: Friedman and Schwartz, 1963. So where do we stand today? Congress's post-crisis review still hangs on a single unanswered query. Are we safer? The answer, frankly, remains hazy. Regulators have bolted on guardrails, yet gaps still show. And in a world where one tweet can ignite panic, those dominoes are still set up. This isn't scare tactics, it's a rallying cry. Stay in the loop. Demand openness. Vote for rules that shield your cash, not just Wall Street's. Beat TextPop. The next crisis won't ask before it hits. Will you be ready? Subscribe to get deep dives into the financial fault lines before the next shock lands. The system's delicate. Knowledge equals